Good afternoon, ladies and gentlemen, and welcome to the i3 Energy PLC investor presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged. They can be submitted at any time via the Q&A tab that's just situated on the right-hand corner of your screen. Please just simply type in your questions and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company can review all questions submitted today and will publish those responses where it's appropriate to do so on the Investor Meet Company platform. Before we begin, I would just like to submit the following poll, and if you'd give that your kind attention, I'm sure the company would be most grateful. And I would now like to hand you over to the executive management team from i3 Energy PLC. Majid, good afternoon, sir.
Good afternoon. Thanks, Jake, and good afternoon to everybody that's joining us on this call. So I'm just to the introductions. I'm Majid Sheffield, and today I have with me Ryan Heath, who's the President of Canada, and Jason Dranchuk, our CFO. So this is a new presentation which is on our website. It went up on our website this morning. So hopefully people either have a copy of it or they can see this one quite clearly. So I'm going to flip through these early slides and move on to this slide 4, which lots of people have seen before, but this essentially describes our business plan, which is to, I can't actually see this very clearly on the screen here, so I'm just going to have my side. Second. Yeah. So this describes our business plan, the circle, which shows acquiring, rationalizing, dividending, and reinvesting. And essentially, it's to acquire when oil and gas assets when commodity prices are low, and drill when commodity prices are high. And so this is essentially what we did when we entered Canada back in 2020. We entered Canada when commodity prices, certainly oil price, was at an all-time low. It went negative in May of 20, and that's when we those deals. We managed to acquire over a series of deals over 2 years, 2020 and 2021, 17,000 barrels a day at around about 1.4 times cash flow and about 0.7 times the PDP value. So really, really good metrics because we bought absolutely at the right time, got lucky in terms of doing that. Are we still on, Jake? Because it's saying that the video's been paused.
No, we can hear you, sir.
Hello? Jake, are we still on?
Hi, Majid. We can hear you, sir.
Okay, I think we're still... Yeah, sorry, no, we just got a message saying the video had been paused, but I'm assuming it's still on. Anyway, so we managed to acquire these assets at really low prices, and because we bought them at those prices, it meant that we acquired all of the upside free. So hundreds of drilling locations came with that production, and we didn't have to pay for them. And that essentially allowed us to set this business plan up, which is to pivot between M&A and drilling. So as I said, when oil prices are high, we drill. Oil and gas prices are high, we drill. When they're low, asset prices deflate with a time lag and we buy. So that's essentially the business plan that we were able to execute quite effectively. So bought in 2020, 21, 2022, oil price recovered in particular, and we ended up executing a relatively large capital program of $100 million in 2022. Which went really well. The wells came in as expected. It was drilled on budget in a really inflationary oil price environment. And then we did the same thing and plan to do the same thing in 2023. Unfortunately, oil and gas prices collapsed in the first half of the year, and we ended up cutting back our capital program in 2023. We have the flexibility to do that, so we don't have to order long lead items. We don't have to spend hundreds of millions of dollars like we would in the North Sea. And in that case, you just have to proceed whatever you're doing. We've got the flexibility to tune up and tune down our program. So this slide talks to our attributes as we now have them. So why invest in i3? So we've got a very strong foundation in terms of both the asset portfolio and the people we have in the company. So we've proven that we can do very good deals at the right time. And through the operational programs that we've executed over the last 2 to 3 years also proven that we can execute projects on time and on budget and with results that reflect what we expected before we went into them. We've built a business that's now producing circa 20,000 barrels a day. That's gone from 0 to 20,000 in 3 years. And the asset base, a really important aspect of this asset base is that the decline rate is low. It's 15% decline rate. And that's obviously important if you're having to spend capital to replace that decline. That 15% is top quartile. So that, as I say, that's a very important characteristic of this business. We've spent the last half of last year and the first half of this year essentially strengthening our balance sheet. So last year in 2023, when prices collapsed, we had to cut our budget back. We also had to cut the dividend back because our capital program and dividend program was based on the consensus budget when we entered 2023, and it just changed significantly. We monitored it through Q1 and Q2 and decided to cut it back. Realized that we really needed to fix certain aspects of our balance sheet. And so that's what we have spent the last part of last year and the beginning of this year doing. We've refinanced a loan that we had outstanding with Trafigura. That itself was a refinancing of the original loan notes that we had. And we've now managed to get on board a very good Canadian bank, National Bank, and have a debt facility that's much more flexible than the prior two debt facilities that we've had. We also did a really good deal to sell our royalty position, which on a production and cash flow basis was relatively immaterial to us compared to our 20,000 barrel a day production portfolio that we have. It was less than 400 barrels a day, but those royalty barrels are valued at multiples much higher than they would trade at in a company like i3. So the combination of that asset sale, putting the cash on the balance sheet, taking out the $25 million of amortization, which the previous facility imposed upon us, has increased our liquidity significantly. And we had to wait for that before we announced our budget plan for this year. So that's what we've done. And that has meant that our drilling program is focused more towards Q4 than it would otherwise be. But that drilling program is very important. So we're targeting some key assets in our portfolio, which we'll talk about later on. And that will allow us to have a very good drilling program at the beginning of next year in some of our key assets, particularly the Simonette Montney play. We are a dividend payer, so at our current share price, which is 10-11p, we pay out about 1.03 pence a year in dividends at the moment, and that's around about a 9-10% yield. That dividend is now very stable, and that's after we went through the experience in 2023 where we flexed our dividend based upon projected cash flows. We now have what we believe is a very stable dividend. We've got a balance sheet that's been strengthened, and so we're very confident in the stability of that dividend. So on the current basis, we'll be paying around about $16 million in dividend. We have paid out almost $50 million in dividends since we entered Canada, and we raised $80 million to buy those assets. So we've been a very effective payer of cash return back to our shareholders. And in terms of the long term, so our business model is returning cash through a dividend and also growing the production base of the business, which ultimately will be reflected in cash flows over the cycle and share price growth over the cycle. We have a number of catalysts that will also will move through that investment cycle that we have. And we've got a very large reserve base, 1P and 2P and PDP, which has lots of drilling locations. We've got a very large inventory that we can attack. So in terms of ESG, so ESG is obviously very important to us, and it's very important that oil and gas companies have an ESG plan that fits with the expectations of their investors. We have done a huge amount of work since we picked up the assets in Canada to reduce our carbon emissions on our emissions intensity. So our current carbon emissions are around about 41 kilograms of CO2 equivalent per barrel. And we've managed to reduce that below the average in Canada. So in Canada, the average for conventional oil production is 48 kilograms, and for conventional gas is 42. we've managed to reduce our carbon intensity by 4.5% since 21, and 8.5% since we entered in 2020. And during that period of time, obviously, we've significantly increased our production. So we've increased the amount of carbon we're producing, but we've reduced the intensity. And that's been through a huge number of initiatives. We've been reducing high bleed pressure control valve controllers with low bleed, or introducing instrument air. We've been electrifying pump jacks. We've installed 500 solar powered chemical injection pumps. We're actually looking at a small solar panel installation on a facility that we have that has a lot of spare land that can be potentially funded by the solar power company through sharing of carbon credits. So, and we're introducing airborne radar technology to detect methane emissions, fugitive methane emissions over all of our facilities, and we're hoping that over the next couple of years will reduce our methane emissions by maybe 50%. So great effort being made there, and we're making investments where it makes sense.
Maybe sort of just one more point on that, just regarding all the good work that we do that we're very passionate about on the environmental side in particular. Those works create carbon credits, and we've got a large cache of those carbon credits to date built up, and to the tune that it's actually offsetting the taxes associated with that on a similar basis. So we're pretty proud of what we've done today with that.
Yeah, they're very valuable, and the companies are focused on this equipment actually make a profit by sharing their carbon credits with us, which in many instances makes it capex neutral for us. So they're actually good investments, as well as important in terms of reducing ESG. We're also very focused on HSE. So the most important thing for us is safety of our people and all our contractors. We have had essentially last year 0 incidents, reportable incidents, and I think maybe we had 1 reportable incident the prior year. And we've been very busy in terms of drilling, but also last year we did a huge amount of turnaround activity on 20 operated facilities, and they were all done on budget and also with no HSE issues. So just a snapshot of the company. We are listed on AIM and TSX. So the company originally listed on AIM back in 2017 when it just had its UK assets. We listed on the TSX in 2020 on the back of the acquisition of a company called Toscana. Just over 90% of our shareholders are in the UK. All the institutional shareholders are in the UK. All the equity that we raised, the $80 million to buy these assets, was raised from London institutions. So London dominates the trading. Our shareholding in Canada has just tripped 10%, which has some implications.
If I can interject there, Majid, thanks. So as you mentioned, we're slightly over 10% shareholdings now in Canada. Up until recently, we had an exemption for the Toronto Stock Exchange, whereby we just need to adhere to the reporting rules of the AIM. So we were reporting half yearly to our shareholders. We will still continue to do that, but additionally now we'll be meeting Canadian reporting timelines. So we will start reporting quarterly to our shareholders as soon as Q1 of this year. And that report needs to be filed, that RNS and financial statements and notes needs to be filed prior to May 15th of this year. And so going forward, we will have more communications with our shareholders. You'll hear from us routinely, at least on a quarterly basis.
Yeah, and I think that will be good for the market, because there's a lot more disclosure that we'll be making under those Canadian rules. So it will make the business more decipherable for everybody. The market cap of the company is about £130 million, about where we're trading at the moment. This is showing net debt at year end of £18 million or 30 million Canadian. We're actually, we have a working capital surplus now, so we eliminated the debt with the refinancing of the Trafigura loan with National Bank. So we're actually in a cash positive position, 0 debt effectively. We've already spoken about the dividend. The other important points on this slide is really the diversity of the portfolio. So it's a very large portfolio that we've built up over 4 big core areas, lots of different types of infrastructure, produced from around almost 900 net wells. We have around about 850 drilling locations split across that portfolio. which themselves are very diversified in terms of the geology that they're chasing and the intervals. And our production mix itself is also diversified. So it's roughly 50% gas, 16% oil, and the rest is condensate and NGLs. That's really important, all of that diversity and the scale of it, in terms of diversifying risk. And as a dividend-paying business, obviously, that's really important for us. So if any of these facilities go down or a number of wells go down, it's not going to have a huge impact on our cash flow. I've already mentioned the decline rate. The decline rate, Ryan will speak about the importance of that later on, but a 15% decline rate is very good, and it's top quartile, and it's really helpful for our business, and it helped us last year in terms of being able to effectively replace reserves without deploying a lot of capex. In terms of the management team, the board, they're listed here. The one person that's always worth mentioning is John Festival. He's the chair of our board. He joined us from Toscana when we took that company over. And he's a hard-nosed Canadian businessman and knows how to make money. Founded 2 businesses and sold them for 3 billion Canadian dollars. So he founded a business and sold it to a heavy oil business, sold it to Shell for 2.4 billion, and another one to IPC, the London company, for 700 million. So it's great to have John as our chairman, keeps us on the straight and narrow. Next page. This just shows it's just a quick overview of the 4 core areas that I mentioned. So this is where our business is now focused, and these were the assets essentially that were acquired in those 3 transactions that we did in 2020 and 21. Central Alberta, that's our core producing areas. Roughly 65% of our production comes from here. It's very gassy. Most of our gas also comes from here. But it's a large position. We own high working interests. We operate, in fact, across all of this, we operate more than 3/4 of this land portfolio, wells and facilities. But Central Alberta contains lots of drilling locations that are very repeatable. They're high-rate gas wells with lots of liquids associated with them. And these are wells that we can just continue to drill year after year in order to maintain production and cash flow. And we will always be drilling some gas wells in here because they generate high volumes and high gas flow, even at sometimes at lower prices. Also partly because they produce a lot of liquids. Wapiti Elmworth is the next production area in terms of size, produces about 3,000 barrels a day. We have more non-operated positions here. It's oil production, relatively shallow, good wells. The Clearwater, we're a relatively new entrant into this, but we're building our position. It's the best play onshore the US in terms of economics. The wells are shallow. It's oil. It's Western Canadian Sedimentary Basin, so it trades at about $10 to $15 discount to Edmonton Light. But the economics are excellent because the wells don't have to be fracked. So they're very simple to drill, very shallow, low capex, and come on very quickly. So we're building a position in the Clearwater. And then the Simonette is the massive catalyst in our business. That's a huge position in the Montney, very big wells, oil wells, and we own this 100%. And this has the potential, if it's fully developed, to produce 30,000 barrels a day of oil production. But it requires a lot of capex. So we've been working up that asset. We needed to drill wells in the north and the south to prove the value of the geology, which we've now done. And we'll now be moving ahead to accelerate the development of the Simonette, which Ryan will talk about in a couple of slides.
So this is the last slide on the historical portion of the company. So this is just a recap of last year, so Jan 1, 2023 reserves evaluation. Despite the reduced budget that we had coming out of the first quarter of 2023, we reduced it on the backs of a significant downturn in gas and liquids pricing forecasts. Ultimately, though, even with that, we functionally maintained flat BOEs a day, or BOEs on a PDP, 1P, and 2P basis. So we had $47 million, or 47 million BOEs on a PDP, 93 on a 1P, and 180 on a 2P. The important point to show is that the ROIs, even with functionally staying flat, all the ROIs increased. Important because it's really highlighting the base production that we own and how much that continues to give. So functioning on a 2 PDP basis, it maintains a 15% decline, which is top tier, as Majid recently said, in terms of our industry. Stable production, massive inventory, considering the size of the company at 20,000 BOEs a day. We've got 390 gross, 252 net booked locations that are real solid drilling locations that we can attack, that we will show you on our 2024 budget in a following slide. So in terms of the value gap that we see, on the bottom portion of the slide, you'll see what we're trading on a per share basis. I think we're roughly, I'll speak Canadian for a second, around 19 cents on the TSX, on a PDP basis at $400 million of value. That pegs us at 57% below our PDP value. There's a large value gap there. And on a 1P, so basically putting no value in for our PUDs, we're trading at 35% of that, and on a 2P basis, 17%. So we truly believe that there's a large value proposition to just get up to a normalized share price in relation to the value of the assets. The two circle graphs off to the side, they're just really highlighting the fact that our assets, our growth assets in Simonette and in the Clearwater are barely touched. And that is something that we are going to advance at great pace in 2025.
Yeah, the only other thing to point out here, obviously the reserves values on here depend upon the strip that the reserves evaluator used at the beginning of the year. And I think the strip at that point was $74 WTI. We're actually trading above that now at 80, and the gas slightly lower, but it's more or less where the gas strip was. So the values on current strip are slightly higher than they are here.
Yeah, certainly.
Ryan and I are going to speak briefly to a couple of our recent developments now. We had two major initiatives that we wanted to address before we solidified our 2024 capital budget and i3's go-forward strategy. First was to change out our Trafigura credit facility. This was a great bridge facility initiated to take out our North Sea loan notes last May. Look, Trafigura has been a great partner and will continue to be a great partner for our commodity sales, but we needed to move on to a more traditional RBL or reserve-based loan facility so that we can meet our operating and capital objectives. In March, just a few weeks ago here, we signed up a Canadian $75 million reserve-based loan with National Bank, a major chartered bank in Canada. It's a very common facility structure in the Western Canadian Sedimentary Basin. This facility truly increases our flexibility and liquidity to i3. And I will say that when we canceled our Trafigura facility, there was no make-whole fees, so there was no cancellation fees on that facility. And that was a conscious decision when we negotiated it last spring. A few really key benefits to our new facility. The most significant is the removal of the loan amortization. This was taking about $25 million Canadian out of our system, which we can now allocate to dividends, or more importantly, over to our capital program. The facility is very scalable. It was penned in a certain way. It is written as a syndicated loan, so we can add loan parties as required and increase the facility easily without going back to the negotiating table. So we're quite proud of this feature, that it's become very scalable to us. The interest rate is lower than our Trafigura loan. Currently, we're at about 9.2%, and the loan is variable. And consensus in the Canadian market is that interest rates should start declining over the next quarter or two, and we'll get to participate in that. So, while we're sitting currently at 9.2%, if the Bank of Canada reduces rates as expected over the next couple quarters, we should be sub 9% by the end of the year. And furthermore, it's a sweep loan. So any cash deposits that are swept directly against the loan. And if we can make draws on a daily, weekly basis, it's just very flexible. So it's very efficient, and it prevents the elimination of unutilized cash sitting on the balance sheet. So we're very proud of that. And then most proud of all right now at this time, so we can start focusing on our 2024 capital budget, is that we are currently zero drawn on this facility, and Ryan's going to tell you how we accomplished that.
So with this sweeping nature associated with the RBL, which is a great boon for the company, because the cash was sitting on our balance sheet before and just incurring interest. With this new financial mechanism that we have in place, that gets swept, so we're not paying the interest on it. And in order to get that down to zero or a sub-zero point, there was an asset that we had in our quiver that we'd been wanting to play at a certain point. And we felt that this was the right time to bring this out to market. So last July, we started putting together the VDR to get this to market, and ultimately had some strong bids. And we're lucky enough to work with a new partner that was a new entrant into the royalty ownership game, and concluded a very solid deal for both parties. So ultimately, what we achieved on this is a sale of $33.5 million Canadian, or roughly $25 million USD. We sold 388 BOEs a day, and basically at the same split that the company currently enjoys. So it's about 50% gas, about 20% oil and condensate, and about 30% NGLs. Those BOEs were predicted to churn $3.6 million for the year. So at that level, that's a 6.9 times cash flow deal, which is multiples over what we're currently trading at in the marketplace. And at 64,000 a flowing BOE, that's USD. Again, it's miles above what we're trading at in the marketplace right now. So we knew we weren't getting value for it. We saw it as a key catalyst to bring ourselves down to a working capital positive position, and finally pulled the trigger on it, because the key was to take the hard knocks, work our way, get really set up early 2024 to deliver strong go forward into 2025. Another note, though, is that we did retain a key royalty asset in the company. So that's in Simonette and the greater Simonette area, and that's 16,160 acres of royalty positions, and around, it's actually about 40 BOEs a day.
Yeah, I guess the only other thing to say about the debt, a couple of things as well. National Bank, it's in our view the premier bank. There are other good banks, obviously, in Canada as well, which we have good relationships with. So don't want to big up National Bank too much, but they are in the middle of everything, really, in terms of oil and gas in Canada, on the lending side and on the M&A side. So it's really good to have them on side with i3, which sets us up in a good position for the M&A side of our business as well. Also, the debt capacity of the business is more than $75 million, which is the credit facility that we've currently got. It's materially larger than that if we want to take it. So at the moment, it's a fairly conservative debt position that we have, both in terms of the size of that facility, but also what we're planning to draw against it.
Okay, so i3 has been, we've been really focused on three pillars to increasing our shareholder values, and this slide demonstrates the execution of this. Since 2020, i3 has returned about $47 million US to shareholders in the form of dividends. And this return represents about 55% of the $80 million US raised over that period of time. So a substantial return of original equity. This equity, though, was raised to deliver aggressive growth over that production period, and from organic drilling, but primarily to fund 5 strategic acquisitions that are listed on this chart. As of most recently, with our April royalty sale, we've also retired all of our bank indebtedness from the recent highs of $56 million of debt. So we're always looking for different ways to build value in the organization. And after all these returns, after the reduction of debt and the return of equity, we've built a 20,000 BOE per day business that, depending on how you look at the reserve values, can be valued anywhere between $300 million or $1 billion of reserve value, and at the same time maintaining a sustainable dividend plus a growth model. So we're still trying to focus on those to deliver both cash back to our shareholders and continued growth in our stock price. Next slide, please.
Again, just maybe hitting that home, just seeing it all come through to fruition. It's a real testament to everybody that's been working alongside on this story to come in here, build up with debt and equity, the land position that we have, and to offlay $75 million of debt. In the meantime, repay back new equity holders to the tune of 55%, and then build up $300 to $1 billion entity. It's been a fun process to be a part of, and we're very proud about where we sit right now.
Next slide here is our guidance and price sensitivities. The expected results here is, this demonstrates what is going to come out of our second half 2024 capital budget, which is really weighted to the second half of the year that Ryan's going to speak to shortly. And the pricing used on our guidance was on a consensus basis in line with our peers. So I would suggest that the annual numbers here are fairly respectable, and especially with being second half 2024 weighted on the capital program. But we really want to focus on the exit numbers here because it is so late in the year that we're really not going to see the benefits of this till we get into later Q3 and Q4, as we took a pause through a little bit of H1 and H2, Q1 and Q2. Production, as you can see here, is going to be back over 20,000 BOEs a day. That's an 8% growth from our current level. So we're still demonstrating some growth in our production base. EBITDA is going to be between $76 and $82 million US. This will help support our Montney and Clearwater development, and I think a big focal point of this is after that capital program is deployed, or we're going to exit 2024 with a low net debt, so about 0.3 debt to EBITDA, and look, I think get fairly respectable numbers for 2024, but really what this is doing is setting the stage for a 2025 Montney and Clearwater focused program.
Yeah, I think that's the key point that Jason's making, is that the key to interpreting the data on this table is that this is a back-end weighted program, because we effectively took time out from capital deployment at the back end of last year and the beginning of this year. So the drilling in Canada is done in the winter period. We didn't do any drilling in Q1, so this has all been pushed to the back. So all the capex is going into this program in this year, but we're only going to have 2 or 3 months of production coming out of it. And we've stabilized the business, so hopefully we don't get into that situation again, that going forward we'll have an annual program that's consistent, which means that you'll have a full year of cash flows coming from the deployed capital. I think that's really the key element to this.
Yeah, and to further push it home, really there was a lot of daylight burnt in the first 4 months of this year. Entirely our bandwidth was purely pushed towards the RBL and the Gore sale, knowing that on the backs of that we'd be in far better position and be able to deliver a solid budget for 2024. So with that, understanding the time that it took to put this into place, it kills certain quarters of the year in terms of being able to provide activity. So it really pushes it into Q4 for execution. So you had to look at man hours available, service resources available, and then accommodate for seasonal pad site access. And so that's what we've done with this budget. So this is about as much as we can compact into the rest of the year. And I think we've done it with a very solid focus on development opportunities mixed in with some exploration upside. That
Ryan, you just want to explain why it's quarterly, the CapEx program?
Yeah, well, it's quarterly because so once you get through say Q1, that's when breakup would occur, and the ground isn't conducive to getting heavy machinery back in on that. So typically production slows down, and then when you get past Q2 and then into Q3, you in particular the areas that we conduct our business in, you need the ground to harden up so you can get back in, bring in the heavy equipment, and then begin operations again. So when I think it was Majid that was saying, because the activity that we had in the Q1 of this year, we didn't have time to focus on the drilling component. And once that's done, it's gone. So really next year, when we set up for 2025, and you'll see how we are going to be set up for it, it's going to hit it. And we're going to have a full development program Q1 to Q4 in 2025. So you can see the production ramp up. 85% of this, the capital program of $41 million, that's devoted just to the drilling and development operations. That's going to be done in H2. And what we're expect to see is about a 5% increase year over year from December average to December average. And hopefully peak out about 5,000 BOEs a day of new production. The split that we're expecting is about 27% oil, 30% NGLs, and 44% natural gas. So there's the $41 million that goes into drilling, and then there's the $10 million that's other, and that other encompasses land and seismic capture. We've got maintenance capital to the tune of about $6 million, and then for workovers, optimizations, reactivations, and other BOE adding activities, there's about 3.5 million. So those will actually produce a return. The wells that we're drilling, you can see the split there. So it's heavily weighted to Central. We've got 11 wells, 7.6 net. Simonette, we've got 2 gross, 1.9 net. And Clearwater, we've got 2 and 1 net in terms of splits. So the 10% of the capex that's devoted to exploration play, it's an interesting objective that we've been working years on, and we're excited to actually get in there, drill that this year, and see if we can find a solid proof of concept on. So as we focus, the budget is really designed to hit our oil locations sooner than later. Obviously, oil is in vogue right now, so we're going to be focusing on the Dunvegans, the Vikings, the Rock Creeks, capitalize on the strength of oil right now. And then as the back-weighted nature and lift in the gas strip occurs closer to Q4, that's when we're going to go after our Glock shots and our flares to capitalize on that commodity. But this is a flexible program. So should gas not come into vogue as we're expecting, there is locations that we have ready to go that are more oil focused that we can switch to.
Yeah, and the overall split out of the 15 wells, 8 are actually oil wells and 7 are liquids-rich gas wells. So as Ryan said, those gas wells will be drilled at the back end of it and coming to really strong. What we're seeing is really strong winter pricing, which is actually the next slide. So this is what we're seeing as the strip. You can see on the left. So this is gas price in dollars, Canadian dollars per MMBTU, and there's actually been a shift here. You can see where we're trading at the moment. We're not trading at very good gas prices in Canada or the US. But the reason that we're seeing a big uptick this quarter is because of the LNG that's coming on stream on the west coast of Canada. So LNG Canada Phase 1 is due on stream sometime early next year. It's effectively mechanically complete. The pipeline's been fully connected up, welded up, pressure tested, etc., and they're commissioning the facilities. So that is going to come on stream. There is also there's in total 4 other LNG facilities that are going to come on stream on the west coast of Canada, which, if they all come on stream, will take out 7 BCF per day out of the Canadian gas production market. So Canada produces around about 18 BCF per day. LNG Phase 1 is 2 BCF per day, so that's allowing about 11%. LNG Canada Phase 2, which is due to come on stream at the back end of this decade, it will be another 2 BCF per day. And there's 3 to 4 other projects which will add up to that 7. They're all real projects. So one of them's got a notice to start construction. The other 3 smaller ones are in the environmental assessment stage. The infrastructure, the pipeline infrastructure, is all essentially there to take the gas to those facilities. It's not just Canada. There are about 20 projects onshore US to build LNG, to export LNG out of North America into Europe. So Europe, as we know, has replaced Russian gas with LNG. And if all of those projects come on stream, if they all come on stream, that's about 30 to 36 BCF per day of US production, which will go into those LNG facilities. US supply and demand is 100 BCF per day. So that's almost 40% of US production. Obviously, not all of those will come on, but even if a small proportion of those come on, it's going to mean that North American gas is going to be linked to the global markets in a way that it never was before. What's particularly important for Canada is it was always held hostage, essentially, both for oil and gas to the US market. This is the first time that Canada is going to export its commodities independently into the international market. And it's going preferentially to the best market. It's going to go to Asia, and it'll have some structural advantages. It's only 10 days to get from the west coast of Canada to China and Japan. The US LNG will have to go through the Panama Canal. That takes 24 days. Even the LNG from the Arabian Gulf takes about 16 days. So it's going to have a huge advantage. And although, there are the actual shippers, so the LNG one, LNG Canada is Shell, Petronas, PetroChina, Mitsubishi, Kogas, I think. They actually own the capacity, but that doesn't matter. We won't be shipping our molecules through that pipeline. But if you take that amount of gas out of the market currently is saying that this is the strip that we're going to see. So that's why We've now got a really positive outlook on gas. We're really happy that we've 52% of our production is gas. We've got a really large gas inventory as well as an oil inventory, and the gas is suddenly becoming a lot more valuable. This is what we're going to be producing, the gas wells that we drill in December. We're going to be producing them into this strip. We've already hedged volumes for next year at this level, $3.40. And you can see the strip for next year is $3.40, and then it's $3.92. Historically, Canadian gas has traded about $2 per MMBTU over the last 10 years. I know we had the anomaly a couple of years ago where it was up at $5-6, and we were multiples of that in Europe. That's an anomaly. Historically, it's $2. So these prices are actually very good. We make a lot of profit at these prices.
Yeah. So currently, we've got 20% of our production hedged at these levels for 2025, and that's going to coincide with the Glocks and the flares that we bring on at the year end. What we hope to do is get that number up to another 30 to 35%. Yeah, this just shows the depth of our inventory. There's a healthy balance between liquids and gas between our portfolio. You can see in Central, we've got a ton of liquids-rich gas locations in there. Great payouts, good rates of return. We've got the Glock that we'll talk about a little bit later, Cardium, Falher, and then in Simonette, Wapiti, and Clearwater, you've got a lot of our oil focus in terms of our upside inventory and objectives. So 391 gross, 252 net locations, and on an unbooked basis, it's almost a double of that, up to 960 gross and 550 net. So a real depth of actual locations that are viable drills with good returns. So shown just on the last slide there, Central, this actually accounts for 67% of the company's net book locations. It's a very diverse area, multi-zonal, a lot of formations to attack. You've got Glock, Falher, Cardium, Belly River, Viking Oil. So we have one way or another exploited all of these fields, but really the Glock is the main star of the play here. So it's a huge marine bar complex. It's 12 miles wide by 40 miles long. It's 30 meters thick, based on 5% porosity on a net pay basis. So it is a very large resource that we're pleased that we've been able to capture this much land base. So 4 of our objectives in 2024 are going to be drilled on this, along with a Falher. So all of these expect kind of high IP returns. So you're looking at 600 to 800 BOEs a day in terms of IP30s on these, and they just deliver. With the Glocks, it's going to be from a singular pad, so we're going to have great economies of scale and going into our own systems at Open Creek. So that further enhances the economics associated with it. The oil shots that we're drilling, so the Viking and the Rock Creek, those two are going to be going into our facilities. So not only do you get good IRRs on the oil shots, but then that's further juiced based on the fact that they're coming in through your plant. So the project itself gets enhanced, but overall it makes your equipment run more efficient, and you get the benefits of the economies in terms of the facilities on an OPEX reduction basis. So all in all, you got a balanced low decline production base in this area. So you can see on the bottom right, this thing is flat as a pancake. What I love about the assets that we put together is that if you look at the 17,000 BOEs a day, that was the base assets that we acquired. It actually has a decline of 12 to 13%. And as a dividend paying entity, that's what you want. So you've got this really low decline asset that just continues to outproduce year over year. On a near-term basis, what we plan to do is drill the 11 gross 7.6 wells in this area in economic fashion, and then optimize infrastructure throughout the area. We've got a massive system of 10-drilled pipelines, compressors, and facilities, and we are constantly finding ways to maximize returns, and then also just reduce redundancies. because it does the same thing. So if you can get rid of some of those, you can produce a better return. So Simon, this is, I guess, arguably the star of the show for us. In 2022, we went in there and we drilled 2 wells to try and provide a proof of concept in both our north and our south. So we'll speak to those in 1 second. But how we put this together, this was originally grabbed through gain back in the day, and then through a timely ROFR, we were able to gross up an incremental 49% in South Simonette. So we own 99% down there. We did that through 3 timely transactions and some incremental land sale acquisitions as well. So we got about 30,000 net acres of Montney at 93% working interest, and this is a thick beast of a play. It's 160 meters thick. We've got multiple benches that we attack in this area. So with an inventory of about 145 net locations. So you'll see in South Simonette, we drilled the 13 of 13 on an IP90 basis. So the first 90 days of production, once it has normalized, we were at 880 BOEs a day, and that was 72% liquids. That's a phenomenal rate from this well. So there were operational issues when we were finished the completion, and unfortunately, this well runs at 82% efficiency. So there was some equipment stuck in the hole, but even with that, this thing paid out within a year and produced peak rates of over 1,100 BOEs a day, predominantly oil. There was a study done by a major firm in Calgary, and they ranked all the wells in 2022 into 2023 that were drilled in the Montney, and this ranked as number 5 in that list. And at the end of the 12-month period of production for these wells, this was still producing at the 3rd highest rate compared to those. And you can see that in the bottom right-hand corner. So the orange solid line that depicts what our type curve is, and you can see that we vastly outpaced on that. The 5 of 33 up to the north in Simonette, that attacks the middle Montney. In Q1 2025, this is where we hope to get back into and drill a efficient 3-well pad. It's ready to go. We know what we need to do for this well now. It was done originally on an ESP basis, so an electronic submersible pump. It wasn't able to handle the sand as efficiently as we hoped. So with gas lift, I think we're going to get far better run rate. Case in point, the 13 of 13, that's gas lift, and that runs at 90% efficiency. So we hope to have the same from that go forward. Just in terms of activity, this has to be one of the hotbeds for M&A in Canada over the past year. Massive acquisitions done by Signet, Kawatno, Crescent Point, Logan, Hawthorne, Whitecap, all around us. So we are the veritable donut hole of M&A activity in this area. Last thing to note too is that we are fully plumbed up here. We're lock connected. Our Y battery is a very enviable facility to have. Right now, you got about 12,000 barrels a day of emulsion handling, 32 million of gas as well, and we have a 9.3 million barrel water reservoir that we can utilize to efficiently conduct our business. So this is a great area, and one that we are going to be attacking in 2025 at great pace.
Yeah, I guess just the final thing to say on that is that this has been a key asset for us since we acquired it from Gain. And what we have previously told the market is that we needed to prove it up. And the wells that the guys have drilled, that Ryan's spoken about in the south and the north, have done that. So that well that's on the picture there, that its production rate could be 20% higher than that, because the bottom 20% of the well, the fracs that we've done there are not connected because they have a fish in the hole. But we've drilled a well in the north, we've drilled a well in the south. We've had great production rates from both. So this was just something that we needed to go through the cycle. And because we've got the Q1 and the Q3, Q4 drilling, it takes a bit of time to drill those wells and then have enough production. So these have been on production for over a year and have proven that they can deliver at very economic rates. So we've gone through that. I wouldn't even call it appraisal. It's not appraisal like it is in the North Sea. The oil's definitely there, really thick zones. It's just proving that the technology can deliver really high rate wells, and that's now been done, so we can move to the next phase, which we're doing.
The key component there is that we've established the productivity of the reservoir, and now it's just what's the most efficient way to get it out. And then with the Clearwater, again, this is arguably the first or second most important growth asset in the company. You've just got world-class rates and returns in this project. Low TVDs, you've got about 600 meter depths on these. Unstimulated wells, you do multi-leg horizontals. So they're a very cost-efficient way of bringing on 100 to 200 barrels a day. So we forayed into this in Martin Hills, drilled up about 350 barrels a day with a partner there, and now we've been slowly moving position to the west there, where you can see Dawson, Seal, Walrus, Cadot, and Durham. That's going to be our focus for 2025. In particular, Dawson, where we have one more commitment well to do. That's one of the wells, and then the second one is a follow-up, which we expect to have superior results from. Where the test well was drilled, arguably it was lower in the system. We want to get up dip and drill a well that we believe that we can outpace that by another 30%. The well was drilled with 6 legs. That's not efficient. These should be 8 to 9 legs at the very least. So scale that up. This is about 115 barrel a day well, and at that makes great economics. So we've got about a 7,000 net acre position in the area, 76% working interest. We've only tapped into 2% of the current land base in terms of development. We firmly believe that with additional success this year and into next year, there's going to be over 200 low-cost locations proven up and booked in short order. Short payouts, less than 1 year. And with a near-term focus is to go back in. We want to drill those wells in Dawson, and we want to implement accelerated development, in particular in around the Walrus and Seal areas. We've got all season access there. That's very critical for this area, because in certain parts, once winter lets up and there's spring breakup, you've got a demob and you're not able to produce your wells anymore. So we're working very hard at establishing all season access, and so our run rates can go year round. The third thing is the work that we did do in Martin Hills. We tapped into an absolutely great honeypot over there, and what we plan to do is go back in, implement a water flood, and have the decline subside and get that thing producing at a flat, elongated production history. Just a note, there's been a ton of activity in and around this area. You've got Obsidian, Baytex, Rubelite, Headwater, Clear North coming in and doing a great amount of activity that will be beneficial to all parties involved. We've done recent JVs with some of these partners, and we're very excited to share learnings and move this play forward faster and in a more efficient manner based on those new connections. So we call this area the Clearwater, but it's not just the Clearwater. It's the flare, it's the blue sky. We have access to those zones, and we're excited to continue on and build out our portfolio in this area. Wapiti, it's one of the areas that we attacked hard last year. This thing can really produce. You've got 2 massive Cardium oil fairways. You've got 1 gas fairway in the Cardium, but then you've got Dunvegan, and you've got the entire Spirit River stack. You got Falera, Woolwich, you got Notikewin. So this is one of those areas that as gas comes back up into vogue, which we believe it will next year, we have a significant amount of locations that are high impact locations that we can come back to and drill up in this area. So we're about 100,000 net acres. And again, multiple productive and prolific Cretaceous deep basin zones. And in the near term focus, what we're going to do is just optimize performance of the Cardium and the Dunvegan wells that we've drilled to date, get the debottlenecking figured out in the gathering systems, and optimize liquids egress. So continue to do what we do. Look at the offsetting producers, see what they've been drilling. It's a very active area. There's Cardiums, the Dunvegas, and there's the Spirit River that's consistently being drilled. So technically, we'll absorb those learnings and implement those into the back end of 2025 as well.
Okay. I guess just one final point on the Canadian portfolio is that essentially we've got a core producing area which gives us production and cash flow repeatable in central Alberta. And then we've got assets that have a bit of an appraisal element to it. And as I say, the appraisal risk in Canada is completely different to the appraisal risk in the North Sea, for example. But that's how you create value. By removing that appraisal risk, you suddenly have this catalyst of value growing. And that's essentially what we've been doing over the last couple of years, both in Simonette and the Clearwater. And we're hoping that 2025 is where we will see the results of that work that's being done on those two assets, particularly Simonette. So the UK, so this is the asset we have in the UK, small discovery, maybe 8 to 10 million barrels of reserves. That would be, have an economic development, particularly if we can get hold of Tane. So Tane is a discovery that sits next to Serenity, bigger than Serenity, and that's been relinquished by Repsol. So that's now available. We're in discussions with our partner, Europa Oil and Gas, and also the NSTA about potentially licensing Tane, and so that we can tie it together with Serenity to construct a development plan that's economic. So that's an ongoing discussion we're having with those stakeholders. There's no capex going into this, so it's a very low overhead to progress that asset. So sorry.
I was just going to say, if you can just go back to slide 13 for a second, just maybe just push one final point home. Thanks. Right there. Yeah. So we're happy with the budget that we put together. I know that I think the industry was hoping to see something that was maybe a bit more aggressive. You can only do so much in this industry in terms of time and deployment of capital. What this does is it really sets us up for a strong Q1 into 2025. We're going to have low leverage on our balance sheet. We're going to have ample capacity and cash flows to really hit 2025 Q1 hard. And again, push that out for the entire year. So I hate killing time and ignoring 2024, but I'm very excited for 2025. But 2024, we're going to see some great deliveries in the back half of H2, and it's going to set us up really well go forward.
Yeah, and the restructuring that we've done on the balance sheet, that gives us a lot of flexibility and financial optionality around what we do and what we choose to do, depending what happens with the results of some of these wells and also what happens with the commodity prices. And if we go back to 2023, when we did the big capital program, the circa $100 million, we initially announced, from memory, $50 million, which we said we would scale up or down depending on what happened to commodity prices. We now have that flexibility for 2025 with a very strong balance sheet and lots of liquidity. And that's the position we want to be in, so that we've got a strong financial base to be able to pay that dividend, but we've also got a ton of flexibility financially to tie in with the flexibility and optionality that we've got with our asset portfolio. We never really had that before. We had a huge amount of optionality on our asset base. We didn't have the financial flexibility. So that's what we've now done. That's the work we've done over the last 6 or 7 months to give us the financial flexibility tying with the asset optionality that we've got.
Yeah, full stop. We've never been in a better financial position.
Okay, so that's the end of the presentation. We've got some time, I think, to run through the Q&A that has been sent through. I think there's about 24 or 25 questions, which we'll try and get through. Jake, are there other questions that have also come through that I should be seeing on the screen?
Yeah, absolutely. Majid, Ryan, Jason, thank you very much indeed for your presentation this afternoon. As you quite rightly say, Majid, we have received a number of pre-submitted questions. We have received a number of live questions that should just be in the Q&A tab for you on the right-hand side. But perhaps just while you review those, ladies and gentlemen, please do continue to submit your questions just by using the Q&A tab that's situated on the top right-hand corner of your screen. But just while the company takes a few moments to review those questions that were submitted already, I would like to remind you that a recording of this presentation, along with a copy of the slides and the published Q&A, can be accessed via your investor dashboard. Majid, hopefully you can now see the live questions, and obviously we have those pre-submitted ones as well. So perhaps if I may just hand back to you guys just to read out those questions and give your responses where it's appropriate to do so, and then I'll pick up from you at the end. Thank you.
Jake, I actually can't see the questions. Is there a button I need to press to see them?
There may be a small blue button on the right-hand side that says chat.
Oh, chat. Okay.
If you click on that for me, and then if you click on the Q&A tab, that will bring up the live questions, sir.
Got it.
Thank you.
Okay. Let me see. All right. So we'll run through. Well, hopefully we can try and get through some of these as well. We're going to run through the pre-submitted questions first. If I can just bring them up here. Okay. So we'll be reading these out and then providing a brief answer. So the first question. Sorry, Ryan, you didn't do the first one. Right?
Yeah, I was just going to say, I think this has predominantly been answered here, but what is the mix of gas and oil wells in the capital budget for 2024? We've got 15 gross wells, 10.5 net, 8 oil, and 7 are mainly liquids-rich gas wells. So we've got 12 operated, 3 non-operated, and roughly 95% operated is what we're drilling there. And second question is, what is the IRR for gas wells planned for 2024, given current AECO prices and forward strip? So how is i3's assumption for AECO gas formulated, given it's above the current strip? That's a good question. So based on current strip pricing, the gas-weighted wells, which i3 has in the 2024 budget, are predicted to produce an average IRR of 43%. And then in terms of the formulation for AECO gas and how we're factoring it into the year. So first and foremost, you use sector consensus as one gauge. Second, you've got to look at the current strip and use that as a weather vane. And then third, how you help counter both of those is by putting in your own hedges. And i3 currently has 32% of its gas for 2024 hedged. So about 18,300 GJs per day at $2.73 a GJ. This is Canadian. I'll apologize about that. And then about 19% or 19 to 20% of its 2025 average anticipated gas production. And that's hedged at $3.12 a GJ.
Next question is, are buybacks still planned for 2024? And if so, how soon after the court authorization should investors expect an update on buybacks? So share buybacks are currently not in the plans for 2024, but we're always evaluating what's the best use of our capital allocation. But I actually believe that this question is actually referring to our recent share capital reduction, because it seems to be mixing up terms. So the share capital reduction is not a share buyback program. This initiative, including the court authorization, is to ensure that our legal entity, i3 PLC, captures the value of its subsidiaries and ensures that there's ample legal capacity to distribute foreseeable dividends for the foreseeable future. So it was a legal process that we're just trying to ensure that we got the legal capacity to do dividends for months, years to come, and that will be the case.
Next question, could i3 publish via presentation published 2022 and 2023 decline rates for its existing wells? Playing out on a well-by-well basis, we've got 860 net well bores. But in terms of a overall corporate basis, we've got a P plus PDP decline that's been proven year over year of about 15%. Again, what I like to tout though is that if you were to take the 17,000 BOEs a day of the base production that we have, that's more akin to 12 to 13%.
Which is really good for Western Canada, where the average is over 20%. So it's top quartile, as you say.
Yeah, certainly.
What is I think this is meant to say, why is exit EBITDA before hedging 6.3 to 6.8 million? Are large hedging losses expected? So our budget is set to pure consensus pricing. Hedge gains and losses are obviously future dependent, but it's also the timing of those prices for the different months, and that has an impact. So the number quoted in the capital budget RNS and in our PowerPoint presentation that was put on stream today, it is an exit number. And in that particular case, because we were trying to demonstrate the impact of our late year capital program, we felt that EBITDA before hedges would best capture the potential cash generation of our projects that were announced in our capital budget. Hedges are a corporate initiative. They're somewhat of an insurance program. Sometimes you make money on them, sometimes you don't. We're not expecting huge losses in 2024. How do we arrive at 25 million net debt just after becoming debt-free in April 2024? Again, I think this was really demonstrated well in slide 13 in our corporate PowerPoint presentation. Our capital program for this year is back half weighted, the $51 million US capital program. So later, we won't see the benefit of our capital program till later in the year, as our spend is going out the door. So our wells will pay out over the next year or two. We'll see that cash inflow coming in 2025. We missed, the window because we had other initiatives ongoing for Q1 and Q2 2024. So the spend is later in the year. We have to utilize debt to get that spend up, but then the cash inflow from, to reap those benefits won't happen until, we'll start to see some benefit later this year, but we'll really see the wells start to sing in 2025. Despite the 2024 capital program, are you still looking for strategic acquisitions at the moment? Have you looked at Razor Energy assets, which are in central Alberta and currently for sale? We're always looking at M&A activity, and we have looked at Razor assets. i3 management does not currently see these assets as a fit for the organization.
Okay, Jason, I think you broke up a little bit there, but essentially, Jason said we're looking at M&A transactions and divestment opportunities all the time. It's a core part of our business model that we outlined at the start of the presentation. We have looked at these assets and they really don't fit for our business. The next question: despite such a highly accretive partial sale of royalty assets, i3 Energy stock trades at a massive discount to its NAV and is probably the cheapest company among peers. How strongly have you been thinking about doing stock buybacks? So we have looked at stock buybacks. I think we've mentioned this before. We've done an analysis of companies that do buybacks in Canada and in the UK, and we really haven't seen the benefit if you do a standard 10% type buyback. So we're not planning any share buybacks, and don't believe that, as I say, that will have a material impact on the share price. We've got lots of return investment opportunities in our portfolio, which we're going to have, which we believe, as we've outlined in the presentation. We've outlined in the presentation that we think we're going into hopefully into a step change in terms of growing value from our asset portfolio. So we want to put the money back into the asset portfolio because we've got high return business opportunities. Question 10: what are you hearing regarding LNG Canada? Will it start operating in late 2024, or its start will get pushed into 2025? Really, I mean, we don't operate that business, and people should really refer to LNG Canada's public disclosure on this. We're hearing things. We heard it could be starting in 2024. I think their official guidance is still 2025, so that's probably what we should go with. I think, as we've mentioned in the presentation, the key point is it is coming on stream pretty soon, and the key point is we're seeing that reflected in the forward strip, which we're hedging into.
And last intel that we have is that the line has been filled, so that's a good sign.
Yep. Next question: regarding UK operations, how likely that i3 Energy with a partner could license the Tane discovery in 2024? So, as mentioned, we're in discussions with our partner and also with the NSTA regarding licensing of Tane. But that's in the hands of the NSTA, and it really depends on how that discussion goes and what they would like us to do with those two licenses. So those are open discussions at the moment. Next question: could you please provide some color on the split of oil and gas being targeted in the current? Ryan, you're going to do this one, right?
Yeah. Sure.
I'll read it for you, shall I?
Sure.
Could you please provide some color on the split of oil and gas being targeted in the current capital program? In terms of gas, what degree of risk is being taken, bearing in mind how unreliable industry price forecasts have proved to be in the past? What are the likely long-term structural implications of what is going on in the LNG space in Canada?
Yeah, I think in terms of the risk component, we've already addressed that. How we have addressed it is through our hedging program that we've layered into 2025. But of the 13 operated wells being drilled, so 8 are oil, 5 are gas wells, and the 2 now operated wells are low working interest at 3.1% in their oil wells. The company is pretty positive about near-term and long-term Canadian gas prices in general. Oil is obviously strong. The prompt pricing on gas certainly warrants a bit of concern, but everybody that I know of is looking towards 2025. The strip speaks to a very strong price component, and we are realizing those prices right now with our hedges. And again, this reflects our sentiments on page 14 of the corporate presentation.
Okay, next question. The return of capital section of the recent RNS stated that as part of its total return model, the company remains committed to delivering a sustainable monthly dividend. With the new debt facility, is the monthly dividend now an option and likely to be reinstated, or was the mention of a monthly dividend an error? I3 have commented that the institutional investors were not concerned about the change from monthly to quarterly dividend. However, are I3 aware of how attractive it is to many retail investors? Yes, so there's an apology here. It was the monthly dividend was an error, and not sure how that slipped through because lots of eyes look at those RNSs before they go out. But really, I think it was in there as a legacy, and I think what we were trying to say is that the dividend we're paying quarterly is equivalent to the monthly dividend that we were paying. That's how that slipped in, but it was an error. We're not planning to move to monthly dividends. We're going to stay with quarterly dividends.
So question 14, I'm not sure we really need to answer this because it's been answered throughout, but as per I3's last corporate presentation, there are around 200 potential drilling locations in the Clearwater. The wells are virtually 100% oil, the oiliest wells in I3's acreage. It only costs about $1.2 million, that'd be a USD number, to drill and tie in. Why is I3 only drilling 2 Clearwater wells when it seems apparent that more oil needs to be added into the mix? Yeah, more oil is always welcome. We systematically have to exploit that play. There are road and access, not issues, but items that you need to overcome. There's also First Nations discussions that need to occur and come first, which we've had great headway with over the past year. We made some wonderful connections with certain groups, and we want to be as prudent and upstanding as we can with those relationships, and those have gone great. And so you can see that in terms of the pads that we have now developed through 3 or 5 core areas there. So again, kind of loaded for bear for 2025.
Yeah, look, I guess this, we've spoken about this quite a lot in the presentation, but when we decide what the drilling portfolio is, there are a huge number of parameters that we look at before we decide what that portfolio is going to look like. First of those is how quickly wells pay back. The cash flow is most important for us, not whether it's oil or gas. Some gas wells produce more cash flow than oil wells. And also physically, what are the limitations to getting that each of those wells drilled? And there are lots of limitations in terms of what's drill ready, whether you can get rigs, whether we've done the subsurface technical work. And we've got a portfolio. We can't just focus on one part of that portfolio because we've got a number of different parts of it that we're trying to advance, such as the Simonette, getting those high volume wells drilled, high volume cash flow wells drilled in the Glock. And all of that needs to be fitted into a limited drilling window in Q1 and Q3, Q4. And this year's drilling window, is, as we've explained, is even more limited. It's Q3, Q4. So whilst it would be great to drill 15 oil wells, it would be great if everything lined up just to drill 15 oil wells and they replaced our reserves and they produced enough cash flow to run the business. So it's never going to be the case that you can do that. It's always going to be a mix. Question 15. As per the capital budget, no budget is set aside for Serenity in 2024. Does that mean no work on an FDP on your website? And the UK senior staff, I3 lists 1, manager of HSEQ, chief operating officer, geoscience evaluator, manager, reservoir engineering, presumably complemented by other UK staff, not ops people. Can the UK staffing level costs continue to be justified given the minimum level of activity? So we've significantly reduced our overhead in the UK to be proportionate to our activity. So we're not actually spending a lot. There's no capex going into the UK. We've done the drilling. There's no more drilling to be done. It's really desktop work and discussions with our partner and with the NSTA about extending the license and potentially picking up Tane. We don't have a manager of HSEQ. We have updated the website. That's a consulting role if and when we need it. And obviously we don't need it because we don't have any operations. We don't have any other operations people. So it's been downsized and really cut to the bone. Next question, what are the latest plans for Serenity beyond looking at various development options, and do the plans depend on Tain? When is Tain expected to be resolved? What is i3's intentions when the Serenity license expires in September 2024? So I think we just answered that question. We're in discussions with Europa and also with the NSTA about Serenity and Tain. Next question, Jason.
The share price does not reflect the true share value. Can you give an indication of what you think the true share value should be? Look, management can't opine on directly what we think the true share value is. Obviously, we think there's a lot of upside in our shares. We're doing what we can to prop that up. But we would definitely defer to. We're covered by plenty of third-party analysts, and we would defer our shareholders to read each analyst report because they have independent views and target prices for our share price.
Yeah, I guess the only other thing to say there is, what we need to do is refer to independent analysis, and the most detailed analysis is always the reserves report. That's a really detailed analysis. They look at the reserves evaluator, looks at every single well, runs the current strip that they've got, which is a consensus strip amongst all the reserves evaluators, takes into account detailed technical work that they do on the declines. So the reserves evaluation is a true valuation of the business. That's obviously always not reflected in the market price. And I guess the one thing to point to is that we trade at a discount to the PDP value, whereas we've looked at this recently. Most of our peers are actually trading at around the PDP value. So that's the discount that we need to overcome.
On slide 9, I know where you're going.
Yeah.
So on slide 9, as we spoke to. So if you have a Canadian PDP value of 401 million, and again, this is evaluated by a third-party engineering firm, and compared to where we currently trade at, we're trading at 55% of our PDP. PDP represents a P90 case of you basically just leaving these assets alone, watching them decline on blowdown, and stripping certain funds to take care of the asset retirement obligation along the way. So with doing that and doing nothing more to the assets, that should yield on an NPV basis $401 million. And we're currently pegged around 55% of that. So that doesn't take into account any other catalysts that we can create in the meantime.
So that's, it's shown there as 25 US cents. That's 20 pence a share. So that's if we manage to remove that discount compared to our Canadian peers and trade on PDP value 20p per share. But of course, we would argue it's worth more than that. But anyway, there's plenty of independent analysis out there, and we're just pointing people to the most technically robust analysis, which are these detailed reserves reports. Next question, would you consider selling any assets if a good offer came in? Yes, we'll consider selling assets as long as it's accretive. And we just demonstrated that in the recent deal we've done with the royalty sale. We're not wedded to our reserves. If they're more valuable in other people's hands, we will sell them.
Yeah, so it has to be accretive, but then you also have to take into account how does the company look after that particular piece is sold. So regardless of value, there's some pieces that sometimes you just need to keep. So 19.
Yeah.
So would you link up with a partner to speed up operations on the many opportunities available? Certainly, depending on the type of JV that's brought forward, if it makes economic sense to do so and can really advance NPV, then you would have to entertain it. And we've got a lot of good partners out there that we do discuss such options with, and it could be a part of what we do go forward.
Okay, next, would you consider linking up with Europa Oil and Gas again for their projects in Ireland and Equatorial Guinea? No, we don't have any plans to do that. Our focus of the business at the moment, obviously, is entirely Canada, trying to extract some value for the UK business. How are you going to get the share price to a fair value level? So look, we just spoken about where our peers are trading at PDP value. So we need to remove that discount and try to trade at PDP value. And we've outlined the business plan and the capital program for this year, which is targeting those key assets where we have a lot of the PDP value. And really, once if we efficiently execute that plan and that capital program, then ultimately, that work will be reflected in the share price. And I think we're moving to, a transitional phase in 2025, based upon the work we've done on the balance sheet and the drilling program we've got and the financial flexibility we've got. We're going to see hopefully some very good results at the back end of this year from this program, which will set us up into next year, and we'll start proving to the market that those PDP reserves values are there. At the moment, gas prices are low. What is your medium to long-term view on this? So, as we've discussed in this presentation and discussed on page 14, we've got a very positive view on near to long-term gas prices, and and that's changed in the market very quickly, just because LNG Canada is real and it's going to come on stream. Everybody now realizes that the traders are trading around those prices, and we're able to hedge into those volumes. So it's real, So it's not strips. Strips move around all the time, whereas this is moved, and it's moved up because that's a real physical project that's going to happen. So we're very positive.
Let's see, page 4 of the i3 Energy slide deck. So section i3 Energy at a glance provides an overview of its assets and areas of operations. One area shown is located near Lloydminster in Northeast Alberta. That's our Hanging Stone asset. What play is this, and does i3 Energy own? And does i3 Energy own drilling acreage here? If not, why is this shown on the overview of i3 Energy's assets? We do own drilling operations there. Potentially can't say too much about it right now. We will update this particular asset in our next quarterly update. But yeah, it's a piece that's not core to the company, so I wouldn't be surprised if this is one of those pieces that we try to monetize and streamline.
Okay, from your year-end report, quote, if the group is unable to develop its North Sea assets, i3 Energy may not recover its loan and investment into i3 Energy North Sea Limited, which could negatively impact the company's distributable reserves and ability to pay dividends. The report goes on to say the group considers the risk level to have increased in 2023 due to approaching the September 2024 deadline for FDP on the P2358 license. End quote. Will i3 have an FDP submitted by September, and if not, what is the impact, and does this affect the dividend? So we're not going to have an FDP submitted by September the 30th. Obviously, the FDP has to await the discussions that we have with the NSTA and with our partners about the status of that license and TAIN. So we're definitely not going to have an FDP submitted. And we've mentioned we're in discussions about the NSTA about a possible extension of the license and picking up TAIN, but there's no certainty that will happen, that the licenses will be extended or that we'll pick up TAIN. But if the court-ordered capital reduction process that's going on at the moment, if that's effected, which we believe it will be, then there's not going to be any issues with dividend payments, even if we have a negative impact with respect to that extension and that loan that's been mentioned. And that's the reason that we're doing the capital reduction process. Next question, what would be the balance sheet implications of any decision to write off the Serenity field? Can you please confirm that, all other things being equal, the capital reduction would leave sufficient distributable reserves to sustain the current dividend if Serenity was given up? Thanks, yes. Just answered that, and the answer is yes. Next question. Right.
Yeah. Please give a detailed update on the Clearwater, including well performance production timelines. I think we've kind of spoke to this throughout.
Okay. Next question. Please give. Jason, you're going to do this one.
Yep. Please give company's current view on a substantial share buyback financed by sale of some assets, particularly in light of extreme low valuation of such assets by the market currently. Such a move may be given greater credence by recent asset sale, which only reinforces the logic of such a move. The company would not sell assets specifically to fund share buybacks. Like royalty barrels typically sell at a substantial premium to working interest production barrels, which is why the company decided to sell its small royalty production portfolio. That capital will be deployed in a high return investment opportunities.
Okay, the new i3 Energy slide deck is up on the website. Last year, i3 Energy management stated that it had started working on improving its analyst coverage in Canada, which in my opinion was lacking when compared to peers. Since then, Canaccord Genuity has started covering the company. With National Bank as the new Canadian lender for i3 Energy, does management have insight into whether National Bank will also be covering i3 Energy? Now, I am the view that banks and funds, including i3 Energy and their peer comp charts that they publish to their investors, will help market how undervalued i3 Energy is to its Canadian peers. Has there been any further updates on analyst coverage? Well, look, we'll certainly encourage National Bank to pick up equity research, but banks take an independent view, and that view is based upon, although the equity research is independent, it's the banks work together and they take a view. Publishing equity research, there's a cost associated with that, and they do it based upon how much revenue they think they're going to make from the company. That's not our call, right? It's National Bank. They're completely independent. It's up to them. We will obviously encourage them and lobby them to do it, and hopefully they will, but it's really up to the company. We are hoping, it's not Canadian, but we are hoping that we're going to get some more analyst coverage in the UK.
And maybe just to get my 2 cents on the National Bank and their equity research, we have been in discussions with them, and so we would hope to see some form of pen get picked up on us in the next couple of months.
Okay, so that's the end of the question. Jakes, do we still have time? I know there's some additional questions which we can answer. I know that we answer all the questions and they go up on the IMC platform. Do we have time to go through any of these?
Absolutely, Majid. You have the room for as long as you need. We will, of course, give you back all of the questions that were submitted immediately after the presentation for you to review anyway. But if you do want to respond to those live questions, then please feel free, sir.
Okay, let's see.
We are getting short on time.
Yeah, we're getting short on time. Let's just scan these. Where are they?
Someone asked, is the dividend safe? What's the current yield? That's from Trevor. I think current yield is between 9 and 10%. And look, we're committed to a sustainable dividend, and we think we put all the pieces in place to be able to sustain that dividend, including low debt, asset sales, and the share capital reduction. So I think we're definitely committed to that where possible, but it's always subject to board approval, of course.
Okay, this one. You continue to execute well and overcome problems facing us in maximizing our assets. Despite this, we seem to have a consistent seller. 2 questions: who is that seller, and can you facilitate removing this overhang? Are we considering use of buybacks? We don't look. We obviously we want trading in our stock. We want more liquidity. All of that liquidity at the moment is in London. The question around research in Canada is a very valid one. We'd like more liquidity in Canada, and hopefully that will happen. So we don't mind having buyers and sellers. If the seller is obviously a buyer, we don't know who this. I don't know whether there is a consistent seller, and we certainly don't know who it is. We're not considering the use of buybacks. We've already mentioned that.
Can you start reporting in common conversions to North America oil and gas, i.e. cash flows per share, can, MMFCF, Canadian dividends, etc. JD, correct me if I'm wrong, and hopefully this answers the question, but we are trying to normalize our denomination down to USD on everything, and I think we're working towards that into the next quarter. Is that correct?
Yeah. Our primary, we're moving to quarterly reporting. What we've committed, though, is for sure in our RNSs and in our corporate presentations to move to a standardized US dollar. We think, that's a medium or a fair compromise for UK shareholders understand the US dollar, and the Canadian shareholders do as well, instead of pounds versus Canadian dollars. As far as getting to the quarterly report, right now we're still set up to do report in pounds and our financial statements, but in anything beyond that, we're going to move to US dollars priority, and then we'll take that into account for the quarterly reports as well in the future.
Okay, I'm just reading these quickly here. Maybe I'll do one more before we have to go. Mark S., are you able to access rigs in Canada? Any anticipated restrictions on production due to rig availability? We've got great contacts with our vendors and tremendous history with the rigs, and the companies owning them over the past 5 years. So we don't anticipate any issues. And when we talk about long lead items, this is one of them. And because the nature of our drilling program, we'll have that all buttoned up and ready to go.
Okay. Do you have any production downtime budgeted for 24? So we are doing some turnaround maintenance. I think in aggregate that adds up to about an average of about 185 barrels a day, Ryan, I think, isn't it?
For the year.
For the year, yeah.
Yeah.
If you average it over the year. With price of oil fluctuations on a daily basis, what price does i3 actually get? Is there an average daily rate of oil? Well, I mean, the price. With price we get is the market price. So it's Edmonton Light, so it trades at a basis differential to WTI. That's what we get. Apart from obviously the hedge volumes, we get the hedge price.
Yep.
You answer that one.
One is any of you convinced enough to buy shares on the open market? Thank you, keep up the good work. I think, well, kind of when time permits and whatnot. We've been buying this year, and we've been buying it around these levels. I've got firm conviction that we're a cheap and great growth story, and the dividends, it's top tier. So for myself, yes, if I could right now, I probably would. Like I said before, we're trading about 60% of PDP value. Can I go out and buy assets? Can i3 go out and buy companies at 60% of PDP? It'd be pretty tough to do. So these are assets that I know. I like the assets. There's a ton of growth associated with them. So to me, yes, I'm a buyer.
Yeah, but we have bought in the market at considerably higher prices than this. In fact, the issue for us is often we have inside information and we can't buy. So there's actually restricted periods of time where we can actually buy stock, which is a limitation.
Yeah, and I was gonna just to piggyback onto that, Majid, is we are all shareholders, we're all owners of this company, and we take this all very seriously. But as you mentioned, there's not only reporting blackouts, but as we're working on royalty sales, financing, we are subject to that insider information, and it restricts us from acting on it. So definitely committed to the organization. We just have to pick our windows when, which is always very limited with everything we're working on, to get into the market and to buy shares.
Yeah, they are. They're very limited windows, and obviously the only times that we can buy is when usually all the work that we've been working on gets finally disseminated to the marketplace. Then there's a cool period, and then we are allowed to acquire on the backside of that.
Okay, this is probably going to be the last one, I think, that we take. So please provide specific examples of John Festival's contribution. Well, we have regular board meetings, so all these major initiatives that we've done, the refinancing, sale of the royalty interests, the capital program, the budget, the board has to be convinced of all of those. And John has very key opinions on all of that, and has very robust ideas about what we should and shouldn't be doing. So his guidance has been central to a lot of what we've been doing. Okay, Jake, I think that's all we're going to be able to do. We've actually got another meeting to go to. So I'm going to hand back to you.
Perfect. Majid, Ryan, Jason, thank you very much indeed for being so generous of your time there and addressing all of those questions that came in for investors. And of course, we will give you back all of the questions that were submitted today just for you to review, to then add any additional responses, of course, where it's appropriate to do so. And we'll publish all those responses out on the platform. But Majid, perhaps before really just looking to redirect those on the call to provide you with their feedback, which I know is particularly important to yourself and the company, if I could please just ask you for a few closing comments to wrap up with, that'd be great.
Yeah, well, firstly, just to thank everybody that's taken the time to listen to us. It's been quite a long presentation, and also to all those questions that came in. Glad to see that people have interest to do that. I think the key is, as we said through here, is that we've gone through a transitional phase over the last part of last year and the beginning of this year, and that was partly, instigated by, having to reduce our capital program last year, and we felt that we needed to strengthen the balance sheet and give ourselves a lot more options in terms of how we're going to finance the developments going forward. So the company is in a much stronger, stable position now to build going forward. We've got a great capital program, which is focused on some key assets. particularly the Simonette, which we'll be beginning to take a strong crack at the beginning of next year. We've spoken about that asset a lot, and I think, as we've said, it's taken some time, as it does in the oil and gas business, to move assets to a certain point. Things don't happen overnight. I know that we would certainly like everything to happen overnight. It just doesn't. But the company's in a much stronger position now than it was 6 months ago. And I think we're going to have a very good back end of this year, and certainly a good 2025. And, the stars are aligning with respect to gas. That's always been a bit of a headache for us, that we have so much gas in our portfolio, and the fluctuations in that that volatility has a big impact on our cash flows, up or down. And I think we're seeing, good strengthening of that market going forward. We're now actually quite happy that we've got so much gas in our portfolio. So I think we've set ourselves up for hopefully very strong performance going forward from this point onwards.
Perfect, Majid. That's great. And thank you once again for updating investors this afternoon. Could I please ask investors not to close this session, as you'll now be automatically redirected for the opportunity to provide your feedback in order that the management team can really better understand your views and expectations. This will only take a few moments to complete, but I'm sure will be greatly valued by the company. On behalf of the management team of i3 Energy PLC, we would like to thank you for attending today's presentation. That now concludes today's session, so good afternoon to you all.
Thank you.
Thank you so much.
Thank you.